And we're back. Episode 62 of You Heard It from a CFP. My name is Matthew Coyle. I'm the Director of Financial Planning here at ACG in Minneapolis, Minnesota. Thanks for coming back. Today we're talking about the end of zero, why this advisor is perfectly happy to say goodbye to the end of low interest rates. And is there an upside to the end of low interest rates? Spoiler alert, yes, there are plenty of them. Let's talk about that right now. Okay, well, unless you've been living under a rock the past 3 years, you are very well aware of interest rates and what they have done in the economy over the last 24 to 36 months. Fed funds rate, I'll put it up on the screen, is really kind of what's driving this. The Fed is steadily increasing the rates due to a number of reasons, and why is not the point of this video. But the point of this video is to talk about areas where it's going to benefit you. But basically, the reason that the Fed is raising interest rates is to absorb inflation and to deal with the effects that we've had over the past couple of years, and to properly reposition the price of money where it should have been probably over the last 8 to 10 years. So let's talk about areas where this is going to benefit you. And specifically, I'm going to talk about 6 of those areas as I consult my notes here. And why I said, like I said in my intro, I am perfectly happy to say goodbye to the era of low interest rates. And I'll talk about that a little bit as we go. We'll start with number 1. It rewards savers. All right, so number 1, it rewards savers. Well, why is this important? Well, many people over the last 10 to 12 years were forced into the stock market when they didn't, frankly, need to be there. And one of the most frustrating things about the last 10 or 12 years as a financial advisor, I'll give you a little insight into my career. One of the most frustrating things about this job is trying to find good returns on short term money in the area of low rates. And frankly, the last decade, that just wasn't there until recently. So I am very, very, very happy to see short-term rates, short-term rates of return on short investments with not a lot of risk come up to reward savers who just frankly don't want to be in the market. If you don't want to be in the market, your money shouldn't be there. And advisors are always harping on how much cash our clients have and how much is invested in short-term money versus long-term money. And with the rise in rates, we now see money market funds, short-term treasuries at 3-4% and higher. So if you are in a position of having bank accounts that pay you 0.1, 0.2, 0.3%, and you're looking for other options, those options are there. And again, I talked about that in episode 61, and I'll put the link somewhere in here. So first, number 1 is it rewards savers by giving them a place to keep their cash and earn a decent rate of return that's not too risky. All right. Number 2, it promotes more responsibility among governments and corporations. What do I mean by that? What I mean by that is this. If it doesn't cost you something to borrow something or to use something or to take something or to do anything, wouldn't you just do it without thinking? Of course you would. And that's what people do with anything, with commodities, with money, with pretty much everything. If there's no downside or no offsetting cost to use something, then realistically, you don't spend the time to think about, well, do I need this or do I not need this? It also forces companies and governments to borrow more responsibly for the people they represent. So if you're a government, you're doing it on behalf of your constituents. If you're a company, you're doing it on behalf of your shareholders. Why? Well, it forces you to examine those reasons, doesn't it? And it also forces you to examine your own costs within your own capital structure, whether you're a government or a company or whatever you're doing. It forces you to examine that and to say, do we need to borrow this money for the long term, or are we borrowing it just because we can get it? So, number 2, it promotes a lot more financial responsibility among governments and the companies that you all invest in. All right, number 3, it rewards the diversified investor. During periods of inflation, different assets perform to different rates. Fascinating chart, courtesy of the Hartford Funds. I'll put it up on the screen here. During periods of rising inflation, post 1970, what asset classes, what areas of the market have done fairly well over those different time periods? So, number 1, commodities. Number 2, U.S. large cap value. And number 3, U.S. small cap. If you are a diversified investor and you're paying attention to your portfolio and you have an advisor that's talking about this stuff with you, you need to be owning a little bit of everything, because not all asset classes perform at the same rate over different periods. And post 1970 is no different. If your entire strategy the last 20 years was buy US tech or buy US large cap growth or buy Apple on margin or whatever it was you were doing, you're missing a big part of the market. And eventually that tide will turn and it will favor a different asset class. Financials tend to do fairly well during inflation. Real estate does okay during inflation. Commodities do okay during inflation. There's lots of asset classes out there that do okay during inflation, inflationary periods, and you should be owning them. So as a diversified investor, you will be rewarded for this. And that is a huge benefit of owning a wide swath of the market. All right, number four, it promotes a more sustainable housing market. When I first entered this industry back in 1998, the Roth IRA was 6 months old. And do you know where mortgage rates were? Exactly where they are right now, right about 7% for a normal mortgage. A 0 to 3% mortgage is not a normal mortgage historically. That's an emergency condition. It is not good for the housing market to have rates that are artificially low or pressed down by the Fed. It is usually a good thing. It promotes, just like it promotes more responsibility among companies and governments, people tend to buy more reasonable, more affordable houses when rates are higher that they can actually afford. When I first entered this industry back in 1998, rates were exactly where they are now. It was considered normal. And you know what? People still bought houses and they still maintained a nice standard of living, and they were able to buy a place they could actually afford in the context of all the other things they have to pay for. So when you consider a normal mortgage rate to be 3 or 4%, historically, that just is not normal. That is an emergency condition brought on by extremely low rates by the Fed. And there is nothing wrong with a 6 or 7% mortgage historically. It is exactly where it was when I first came into this business back in 1998. And people tend to buy more affordable homes they can actually afford. And in this country, homeowners are very, very important. We make a lot of accommodations for people owning and maintaining their own property. You can write off your interest, you can write off your property taxes if it's under the cap. And of course, it's never a bad thing to be a homeowner, assuming you can afford it. And interest rates are a check and balance on that affordability, and they do promote a sustainable housing market. And the next generation does deserve to have that chance. So let's hear it for high interest rates in the realm of affordability. All right, next up, wages and your estate plan. Leo has decided to join us here. Hey, buddy. You are very likely earning more money this year and next year than you did the previous year. Did you know there's a very historically observed relationship between wages and inflation? I'll put it up on the screen as soon as Leo stops looking for my attention. So, post 1960, the Federal Reserve keeps very good data on inflation and wages. And there's a very clear relationship between the rise in the two of these things. So that's number one. You are likely making more on average, and this is all about averages. In the long run, most people make more during periods of inflation, yet they don't really realize it. And second of all, your estate plan. I'm going to invest in dog food here pretty quick. Um, your estate plan is likely to benefit. Do you own a whole life insurance policy or a permanent product of any kind of insurance product? You are likely going to get a bigger dividend check as a result of this, or a bigger interest payment from your insurance policy this year than you did the previous couple of years, because they invest in the same things you do, but they're not allowed to invest in as much stock. They have to buy bonds and interest rate products. And as a result of that, they will make more money and pass that on to you in the form of better cash dividends and interest to your estate plan. So, a couple more areas you probably didn't realize that, that you were benefiting from. Next up. And finally, number six, do you like to travel? Do you have a trip coming up in the next year or two? Do you like to travel internationally? Well, if any of those things are an answer of yes for you, then you may be benefiting from a stronger US dollar as partially a result of higher rates. With higher rates makes our currency more attractive for outside investors. So if you're in a place like Japan or Germany where rates are relatively low and you want a stronger return on your dollar or your currency, you buy US dollars, you invest those dollars in our securities over here for a higher rate of return. That puts a bid to the dollar. It makes our dollar worth a little bit more and benefits travelers who like to travel internationally, or perhaps if you have family that lives internationally and you like to go see them, whatever. You are very likely benefiting from a stronger US dollar. Maybe you didn't even know that, but that is also a benefit of higher rates. Makes our dollar more attractive. So, given that background, I think I'll call it good for today. I probably should go feed the dog since he's still looking for me. And in the future, I will hope to see you again. Don't forget, your most valuable asset is, of course, your time. Thank you for sharing yours with mine. Hope you enjoyed the video, and I will see you next time for episode 63, whenever that is. So, take care. Thanks.